Hey everybody, welcome to Mortgage Today for Friday, September 22nd, 23, and oh, what a day it was after yesterday's activities. We started looking at the UMBS 6% coupons today. They were up 25 basis points in the first hour of trading. S&P futures were up 14.75 points. It was a fairly calm and decent trading morning between the overnight and early domestic sessions. Treasuries rallied at the start of the European trading, gave some of the gains back, and were then rallying to the best levels of the day in the morning. The 10-year Treasury briefly touched 4.5 in the overnight session, which is the highest level since 2007. A combination of rising oil prices, economic resilience in the U.S., and massive government supply is pushing yields higher. The Fed futures indicate a 40% chance of an additional rate hike in 2023, which seems low, aligning with Jerome Powell's cautious approach to rate adjustments. Following the recent Fed meeting, the December 2024 Fed futures increased their forecast by about 25 basis points. We also got news that the average U.S. credit card interest rate is now over 22%, with 39% of those capped at 29.99%, presenting a debt trap risk, making debt consolidation refis an option despite current mortgage rates. So this is about the topic that there are likely going to be some people that are forced into precarious positions with their homes, where even though they have a 3% note rate on their mortgage, their other debt is going to force them to either make a decision where they cite pride and sell their house instead of getting rid of a 3% interest rate, or they're going to have to do a cash out refi or file bankruptcy. So with credit card debt being at all-time highs and student loans coming back into repayment, there's going to be a lot of households faced with tough decisions. We also got news the U.S. economy witnessed stagnation in the third quarter's end, as per the S&P Flash PMI, marking the worst performance since February due to falling demand and rising energy prices. When you couple stagnation with inflation, you get stagflation, which is as precarious as the name sounds. While layoffs haven't occurred, the dwindling demand could initiate them soon. It seems like September only just arrived, but our sights are already on October as the scene of the next major battle in the bond market. Today's trading session offered nothing of value, although it was nice to see a token correction in bonds after hitting multi-year highs yesterday. The coming week will be hard-pressed to reshape the narrative given the absence of big-ticket data, but the following week has it in spades. We got a token correction, like I said, after Thursday's familiar pattern in overseas markets following through on Wednesday's post-Fed implications. This doesn't speak to any bigger picture momentum. It's more an afterthought. Big decisions are more likely to remain on hold until the first week of October. At the end of the day, we were up 26 basis points, which we needed on that 6%, which ends us the week and ends the day at 99.34, which puts us well into this bottom little range here, which is bordered by a floor at 98.994, wide range with the 25-day moving average at 99.7 up top. So we could see some bounciness in a wide range like that. We also got some news that Home Point has agreed to, you remember Home Point? Gosh, I remember that name. Has agreed to part ways with $5 million. Why, you might ask? Oh, just a minor case of allegedly embellishing how fabulously they handled costs right before their 2021 public debut. But hey, who hasn't exaggerated a bit on their resume, right? Investors not appreciating the creative fair filed for grievances in federal court in Michigan. These eagle-eyed investors cried foul, pointing out a teeny tiny spike in Home Point's quarterly expenses from $84 million in 2020 to a slightly higher $227 million in 2021, and oops, there was a pesky stock price plummeting 18% by May of 2021, which is awkward. Keep in mind that Home Point is about to get gobbled up by Mr. Cooper Group for $324 million. Sounds like it's going to be $319 million. So let's take a look at next week. We got data, not much on Monday. On Tuesday, we get building permits and some home price appreciation data, which is always kind of weird, but doesn't really move the market anymore. On Wednesday, we get some news. We got the core capex and durable goods, as well as crude oil inventory. Inventory is going to be interesting because energy prices have been a big driver of inflation the last couple of reports. On Thursday, we get jobless claims. Jobless, where everybody's got all eyes on jobless. We also get the GDP deflator. We get some corporate profits, but the big one is GDP advance, which tells us about inflation. And then big one is going to be Friday core PCE month over month and year over year inflation, as well as a little bit of consumer sentiment. So I hope you all had a great week and you have big weekend plans. Enjoy the last bits of summer and check out some of our sponsors at wellthatmakesense.com, as well as some of our common influences and things like that. Let's learn something, folks.